they're joined.
Afternoon everyone, a warm welcome to you all to this webinar hosted by Credit Strategy and Dealflo. My name is Marcel and I'm the editor of Credit Strategy. We're going to discuss during the next hour how automating credit agreements can help lenders achieve three quite elusive goals. So that's increasing customer acquisitions and making that process efficient, improving the customer journey and reducing risk in every part of your business. Now, this last element of reducing risk is going to be quite important for this discussion. It's the lens through which we're going to be focusing on automation of credit agreements. I think we can be fairly certain that this aspect of managing risk while increasing sales is going to become even more critical as we move into 2018. Plenty of reasons for that. There's an unsecured consumer credit bubble in the UK that has now surpassed £200 billion. With both the FCA and the Bank of England questioning the sustainability of that. We're going to have a claims management industry too that will soon be looking for new loopholes to seize upon after the PPI deadline closes, and that might of course include mis-selling and enforceability. So today we're discussing how automation can help reduce risk in that kind of gathering perfect storm. In short, we're looking at the role of automation amid a rising risk of defaults, claims firms, as I've said, hunting for new opportunities, and potential agreement enforceability claims amid what we can expect to be closer regulatory scrutiny. So for clarity, what we're talking about today is end-to-end automation of financial agreements. We're talking about e-signature, but that's one component of others necessary to kind of fully automate financial transactions. So we're going to explore the kind of granular practical details of the reasons why companies automate, the business case for automating agreements, and the benefits from an operational point of view. We're also going to be exploring how automation and e-signatures can help ensure compliance, reduce the risk of complaints, and ensure that credit agreements remain enforceable. Another crucial element of the wider context to the discussion is, of course, consumer expectations. I think it doesn't need me to tell you that customers expect nothing less than convenience, and competition, particularly in retail banking with new entrants, is pretty fierce out there. Of course, we've got new directives coming in, open banking and PSD2, which I think we can say are going to serve to fuel and heighten this pressure slightly further. So in that context, we'll also frame the discussion around where automation fits in ensuring that those consumer expectations are fulfilled. But before we get into the full discussion, it's time to introduce our co-hosts leading today's webinar. First and foremost, we have Abe Smith, Chief Executive of Dealflo. Abe is an experienced CEO with a 20-year leadership record in the financial services and fintech sectors. As founder and chief exec of Dealflo, he has built the company from nothing to automating over £10 billion of credit agreements per annum within just a few years of operating. Afternoon to you, Abe.
Good afternoon, Marcel.
Also joining us is Lorna Brazell, partner at the law firm Osborne, Clarke. Lorna specialises in computer law and in particular the law relating to electronic signatures and identities, on which she has written a book now going into its third edition. Before going into law, Lorna started out in computer programming, so she has a very good grasp and understanding of the technology that underlies e-signature as well as the court's approach to it. Afternoon to you, Lorna, too.
Hi.
Thanks for joining us. Also joining us is my colleague Amber Ainsley-Pritchard, our senior content writer. She'll be putting some poll questions to you as listeners. They're very quick and fast and simple. And Amber, perhaps you could take listeners through that very first question.
So the first poll is, are you planning to automate your credit agreement process? Each time we ask a poll, it will come up as a box out on the screen and you'll be able to answer automatically. You'll also be able to ask questions during the session. If you just look below your slides, you'll be able to enter them there and we'll answer these at the end of the webinar.
Thanks, Amber. We'll continue as the audience answers start to flow in for these polls, or the first of the polls. Just to reiterate, this is very much an interactive webinar. Amber, as she said, we're asking a few more questions to yield some information about your current thinking on credit agreements and enforceability. So please do send in your answers. Please do send in your questions, as she mentions, to Abe and Lorna. We'll come to those right at the end. Feel free to ask anything quite generic or quite technical. If there's anything that we run out of time to answer today, I'm sure Lorna and Abe will be happy to come back to you separately. And as Amber mentioned, on questions, you can also post your comments as the discussion goes on. And as we talk through, you'll see some slides on the webcast window too. So I think that is pretty much the housekeeping done, and it's time to hear from Abe. Perhaps Abe, you can kick us off with an overview on what the business case is for automating the credit agreement process.
Sure. Well, the business case, I guess, has traditionally been twofold, which has been increasing sales and reducing costs. And that's a business case which I'm guessing most people on this webinar will understand very well, and it's been around for a while. And I say traditionally because the way in which historically that business case has been achieved is using things like electronic signature, and oftentimes quite basic forms of electronic signature, and everyone on the call, probably around this table, is familiar with the kind of tick box approach. I'm guessing we've all subscribed to a credit card or some kind of terms and conditions using a tick box. And you know, that drives that part of the business case pretty well. But obviously, you know, in the context of your introduction, it's not all about sales and costs. But let's unpack that for a second. So if you are able to automate the process, if you're able to mitigate the extent to which an onboarding process for a credit agreement reverts to a kind of human interaction, then you can streamline the user experience, or the UX, and a streamlined user experience tends to generate more sales. So what do I mean by that? You know, we're probably all familiar with a scenario whereby you have to print signed documents, possibly send stuff back, possibly attend a branch, possibly rustle up physical ID. You know, all of that is a hassle. You know, all of that takes time, and all of that puts people off. And so, you know, our clients, oftentimes before we do business with them, have quite considerable drop-off in the onboarding process because of these manual steps required. So, you know, improved UX can considerably improve the sales. You know, we have customers who have increased their conversion rates by as much as 25-30% by automating the process. The other point, which kind of goes hand in hand with automation increasing sales, is reducing operational costs. The issue with people is they're expensive. And they're expensive in multiple different ways. Firstly, they're expensive in terms of the cost of employment. But secondly, also, people are not as reliable as automated processes. You know, we all make mistakes. And sometimes those mistakes mean applications have to be resubmitted. Sometimes those mistakes end up in a lost customer. Sometimes those mistakes end up in compliance issues and issues around mis-selling. But invariably all of those add to cost. So if you can remove all of those human variables, if you can automate the process, then you are going to start saving money. And that's something that we see not just with us, but with, you know, also traditional electronic signature systems also. Okay,
it's probably worth coming to our next poll question here, Amber. Mm-hmm. This is on this kind of a more broad point on the ways in which customers can kind of give up basically and walk away during the onboarding process. So if you can read out the next question for our listeners.
So the next poll question is, do you currently lose out on gaining new customers because of a bad customer experience during the onboarding process?
Thanks, Amber. I think there's probably wide scope for that to happen due to the kind of multifarious ways in which the onboarding process can take place. And after things like the mortgage market review placed more onerous conditions on borrowers to actually prove their worth and their affordability as a borrower. But perhaps you can elaborate more for us on some of the reasons why customers might walk away during the onboarding process, and tell us more about the business case for automation.
Sure. Right, just kind of by way of preamble, Ernst & Young did a very interesting piece of work on user experience and the extent to which it affected customers' relationships with their providers. And one of the headline stats I found most interesting was they concluded that 80% of customers would consider changing their provider, and this is in the context of financial services provision, just because of user experience. So, it's something that customers take very seriously, and the industry should take very seriously, and it's also something that's going to come into sharp focus with the changes around PSD2. So that said, what are the reasons why some customers walk away? I think we touched upon some of them when I was talking about the business case. So basically, making customers today, particularly we find millennials, are used to completing an application in the medium of their choice. And if that choice starts online, they want to complete it online. And they want really to achieve the user experience of a transaction, even for a process which is underpinned by a contract. So they want the speed and convenience to commence, execute and complete in a matter of minutes online without having to print stuff off, find letters, stamps, send things anywhere, or visit any branches. So anything that doesn't have a level of convenience is going to start losing customers.
Okay, and I think you've already mentioned e-signatures a few times. So what is it about some of the more traditional electronic signatures that renders them unable or perhaps less able to deliver some of these benefits we're unpacking, such as the reduced risk, the improved operational cost, the increased acquisition?
Well, even traditional or even own-built electronic signature will absolutely deliver some of the upside around sales if it's convenient and it's well thought out from a UX perspective, and may well deliver some of the upsides around costs. I mean, the reduced cost of human interaction, i.e., increased automation. But under the surface, what it may not deliver is reduced risk. Oftentimes, there's a kind of seesaw of improved UX on one side and risk on the other side. And by improving the UX, often the risk goes up, or can do, and by reducing the risk, often the UX is worse, the user experience is worse. I think what's interesting today is that really the business case that our clients are demanding and that we try and serve in the marketplace is more of a cake and eat it. So, is there a way, and if so, how? And I think we'll come on later to discuss how in this webinar, of simultaneously reducing the risk, and by risk I mean not just financial risk, but also legal and compliance risk of a transaction, but simultaneously get the upside of increases in conversion and sales and reduced operational cost. We believe there is, and I think we're going to start unpacking that later in this discussion.
Okay, Amber, I think you also have a question for the listeners on e-signatures as well.
Mm-hmm. The next poll is: are you considering replacing your existing e-signature solution?
Okay, thanks. That should produce some interesting results. For the listeners out there, you can just click on Get Results on your webcast window to see, to kind of benchmark yours with other answers. Before, as you've already mentioned, we move on to the operational details of automation and best practice. Perhaps you could just unpack more of these three benefits of reduced risk, improved operational cost, and increased sales. Reduced risk, as I mentioned, seems to be quite important one because the growth and influence, particularly at the retail banks, on the kind of risk and audit and compliance.
Yeah, so I think we've already touched upon some of the points about the benefits of increasing sales and improving operational costs. But again, they're inherently removing physical and manual processes from the onboarding use case. So I think there's not much more to say about increasing sales and improving operational costs. I think what is interesting, I've given you an example of increasing sales. I think touching upon improving operational costs, what we, and I can only speak from our experience, what we'll often see is a change in terms of the onboarding process from weeks and days to minutes, and in some cases even seconds. Now that might seem scary for the compliance-minded on the call.
Absolutely.
But so the next part of this discussion will go on to, okay, if we are reducing that operational cost and the time scale to onboard so massively, often 90% by 90% plus, how do we mitigate risk hand in hand with doing that? I think that's the area that most of our clients are laser focused on, particularly today.
Yeah, I think it's, as you say, convenience is king at the moment, and it's far too easy, particularly for millennials, to find another product that suits them in seconds.
Well, and let's put that in context. I was with the head of digital for one of the UK's top 5 high street banks. I won't say which, for obvious reasons. And we were discussing, and they've been using for several years, a click-to-sign onboarding process for credit, for new-to-bank credit customers. And this individual reveals to me that they found it particularly challenging as a high street bank to go and find the evidence resultant from that onboarding process. So there were lots of different components of evidence, some bits of ID verification, some document checks, some bits of terms and conditions, and some consents from the customer. But those different bits of evidence were in different places. Some of the evidence they didn't know where it was and couldn't find it. Other bits of evidence were not protected in any way. And aside from the difficulty in purely finding the evidence, there was an added level of difficulty in proving that all of the evidence pertains to one individual transaction and that transaction only. And bear in mind, this is evidence that underpins now several £1 billion worth of lending. Now those are the issues that really the traditional click-to-sign services, which this bank had been relying upon, really do not solve for, and may not have ramifications, negative ramifications for years, until they're put under the microscope. But really that, especially with the kind of today's environment, is only a matter of time.
I'd say, well, just hearing some of the speeches that the FCA and the Bank of England make on, particularly on unsecured credit, you can imagine that there is going to be some form of perhaps maybe informal intervention where they're going to trawl through some of these agreements and just look at how some of the lenders have proved the extent to which lots of their lending is sustainable and that information is captured at the right way at the point of customer acquisition.
Yeah.
But if we move on to the kind of second half of our discussion, which is the kind of the bones of how to automate the agreement process. In this section, we're going to explore best practice, as I've mentioned, and operational practical guidance, and we'll move on to how automation can ensure the enforceability of credit agreements. Perhaps you can start us off again with how automation can prove the identity of the customer and that they saw what they signed up to, which is obviously a vital component.
Yeah, so at the outset, there are kind of five main things that really need to be solved for. So think of these as questions. So think about your own credit onboarding process, and think about the extent to which you're able to answer these questions. And these questions seem pretty obvious, but subsequently, Lorna particularly will unpack these questions. But obviously, we need to know who the customer is. We need to know what they saw. That seems obvious in the paper world. That's nice and easy. But in the electronic world, that becomes much more challenging. But we also need to know what they did. We need to understand how they reacted, oftentimes, with particularly the terms and conditions of credit agreement. We need to understand or make sure that the evidence that we've accumulated during that transaction process is relevant to the transaction. And we also need to ensure that the evidence is easy to use, particularly by the lender. It's no use if we're producing lots of complex technical evidence which is difficult to use. So if we go on to the first point and unpack that a little bit more, who is your customer? So in terms of identity, this I find is the most often kind of misunderstood area of evidence. And really, you can think of identity in two different ways. The first way is know your customer, or KYC, with which most people are familiar. But the second point is prove your customer. So it's one thing to run an AML check or to find your customer in a database or a government database, or to do an ID check. It's quite another thing to prove that it's that customer signing the agreement in real time.
Absolutely. So know your customer. Hopefully everybody is familiar with what you need to establish that a particular identity exists in the world. You want something that ties a name to a physical address or to another evidence of an existing person, electoral roll, some other criterion which demonstrates that such a person as the applicant for this credit agreement really exists. That information you want to be able to capture which of the various forms you could be relying on you have actually checked, because it's all very well to say, oh, well, we could have looked at this, that or the other, but if you can't show that you did so at the time, then you're not going to be able to demonstrate that you had gone through the necessary due diligence process before entering into the transaction. So a fairly straightforward set of information you need to collect to prove that this identity exists, but in the electronic world, the second half of the process is a lot more difficult. It doesn't matter how sophisticated the identity information may be. You could have proved that this identity exists and lives at this address and is on the electoral roll and previously attended such and such a university. But if the person who's actually clicking to sign or using another form of electronic signature isn't the person to whom that identity belongs, then they have a very good basis for objecting when you go in and try to enforce the agreement against them. So you need to do something to bring that identity, which exists in the real world, and this customer together in the form of records of the interaction that you had with them at the time of entering into the agreement, to demonstrate that the person entering into the agreement was indeed that person. Now, the form that seems to be most common at the moment is very much around knowledge-based identities. So I am regularly asked about a particular bank account I set up fleetingly for the purposes of a professional loan 6 or 7 years ago and promptly forgot when I'd paid the loan off. But it's become the most important criterion of my identity, apparently, because it's only the second current account I'd ever opened, and it's something that the financial services industry clearly thinks nobody else would know about but myself. So I'm regularly asked about that fleeting current account, but an equal question could be about schooling, it could be about relationships. If you've got a spouse, what's their occupation, what are their middle names, that kind of thing. Ultimately, we may move, as the slide suggests, to some kind of biometric means. So many of you will have an iPhone which can unlock based on your presenting your fingerprint to it. That's a biometric which ties your holding of the phone at this instance in time to you, the physical person whose fingerprint that is. But until that becomes universal, we're still going to be reliant on more traditional forms of identification, and knowledge and biographical identity is probably the most reliable of those.
Yeah, that's interesting, because it's definitely one that a lot of our clients request. And I think the other interesting thing about the prove your customer piece, sometimes called anti-impersonation, is when in the process that happens. Because the greater the extent to which the anti-impersonation is separated from the signing, the less useful that information is. If it happens way before the signing, you are to a lesser extent proving it's the customer in control of the signing piece. So our clients tend to demand that the knowledge-based authentication piece is done almost as the act of signature, certainly within the signing process.
Okay. I think we're also going to talk about evidential, propriety, completeness and integrity as well, because that's probably something that many clients are kind of grappling with and have been for some time.
Yes, we are. If we can maybe If we can come on to that point at the end,
Yep,
because
sure.
we'll touch upon a few different types of evidence, and
Of
we
course,
treat all of that evidence together is probably best done there. So I think the next point is really around what the customer saw. And again, it sounds obvious in the paper world, but we find very often when particularly when we replace a more traditional electronic signature system, they have had difficulties proving retrospectively, sometimes years later, exactly what the customer looked at on the browser when they were signing an agreement. And so there are a couple of different approaches to this. So let's assume that what we mean by automation is customer signing things on a browser, customer being onboarded on a browser. So on a browser, they're looking at content. And we see, by and large, two different approaches to serving that content on a browser. One is you can think of as HTML, building a website of terms and conditions, a web page of terms and conditions that the customer will then click a box in. And the other approach is really presenting that contract as an image for the customer to view. And there are big differences between those two different approaches.
The problem with the HTML approach is it is by definition transient. What is displayed on a website at any moment in time depends on a whole load of information that's going into the back end of the computer that may change from week to week as the bank updates and changes its systems or indeed its terms and conditions. And the issue then for evidence capture is to be able to demonstrate with very little room for doubt or concern that these terms and conditions upon which you purport to rely are the ones which would have been presented to the customer at that point in time, which, as Abe's pointed out, might well be 2, 3, 5 years after the signing process took place. So this is, I think, goes to really the essence of what makes people anxious about doing agreements through an automated process, is the possibility for a surface veneer, which is all that is seen on the surface of the device, whatever it may be, actually won't withstand challenge. At a later point in time, you'll need to be able to unravel a series of changes and then attempt to establish that what is now left behind after those changes have been unticked is what the version was at that date. So it's not necessarily unsatisfactory, but it just raises a level of anxiety. On the other hand, if you've captured a photograph, you've necessarily captured only one instant in the process. So you've got an image, you say that is the image which was displayed at that time, but it may have been, for instance, part of a sequence of images, so the customer may have moved through several different pages and never really paused or focused on this particular set of terms. And of course, an image doesn't necessarily reflect the learning which the customer has taken from going through that process. It's not quite as bad as talking about subliminal advertising, where ideas are flashed up on the screen very temporarily, so the subconscious recognises them, but the conscious does not. But nevertheless, a single image, when you are trying to explain as to a regulator or to an enforcement court at a later date, we took them through this progress, they understood and accepted these terms on the basis of this information, is just a little more difficult than it needs to be. And of course, it isn't just the one set of information that the customer has to have been presented with. There's going to be pre-information, there's going to have to have been the explanations around affordability and so forth, which are required by the law. So an image of simply a single point in time isn't going to capture all of the information that you're then potentially going to be challenged on down the line.
So I think that is a very good segue into what the customer did. I just have one other point, maybe an interesting point that some of the listeners may not be aware of. In terms of presenting the contract as an image, I think all reputable e-sign companies, even traditional e-sign companies, use the methodology of presenting the contract as an image. But what we have found with some of those methodologies is the image is divided into two components: the contract and the signing block, which is overlaid on top of the contract. And these two images are of different sizes. The signing block is very small size, contract much bigger size. That's fine if you have a fast connection. But what we've seen, and our tech team has a video of this, is if customers on a slow connection, maybe an impaired or mobile connection, the smaller image loads first, and that's the signing block. Under those circumstances, we've seen the ability to actually sign the document without having seen the contents of it. And that's not a situation that any financial services company or any lender wants. That's just, again, it's just a nuance of best practice in terms of serving the image of the contract. But moving on to Lorna's point, it's not just about the image. It's really about the process. We find, so we're getting on to what the customer did here. In our customer base, by and large, the most common challenge that their end customer, the borrower, has is typically not around identity. It's not the end customer saying, this simply wasn't me. It's around the process. Their intent to be bound. Did I see the terms and conditions? How long, did I see all of the documents? Were they presented in the correct order? How long did I have to review? Did I confirm that I had actually reviewed the documents? Did I sign the direct debit mandate? Did I scroll to the bottom? It's all about the process. So what the customer did becomes very important.
Particularly given that customers are generally very reluctant to stop and read detailed terms and conditions or pre-notifications, no matter how necessary they are to their mindfully entering into a process. This is essentially forcing the customer against their will to act in their own best interest. They won't. You can have a pause on the screen for 10 minutes showing them nothing but the terms and conditions, but 999 out of 10,000 will only gaze away, wait until the screen moves on and they can do what they want to do, which is attach their signature and hopefully get the release of the funds.
Yeah, one wonders if the point of how much can I borrow is just far more important to them than the scripts of T's and C's, basically. And that seems to be a common perception, I think.
Absolutely. I mean, it's been a mantra from the legal profession since I started training some 20-something years ago that documents have to be made clear and simple for people to read because complicated text just puts all consumers off. But nevertheless, the concepts being explained are complicated, and you can't simplify them down to the level of a ladybird book because you lose the meaning and the important subtleties. So we're facing an impossible challenge here to try to ensure that consumers are given time and understanding to tackle what is actually an important legal transaction, but not make it so clunky that they give up and go and borrow the money from a maid.
Actually, I have a question for you Lorna, on this point. Very often, when we're trying to sell our solution to clients, we tell them about how we can record the whole process. And some clients get excited about that, and occasionally there's someone, more often than not in compliance, who gets scared by it. Who gets scared by the prospect of recording the fact that the customer obviously didn't read the terms and conditions. And our counter to that is, well, you can never tell in the paper world whether a customer read the terms and conditions. At least if we're recording the process, we can record the fact that it was the customer's choice to spend as little time. Well, what would be your view on the kind of relative merits of both those different approaches?
The key thing from the lender's point of view is to record the fact that the customer was given the opportunity to read the terms and conditions. And there's actually the only case the Court of Justice of the European Union had to decide yet on electronic signatures in any form was exactly that. It was a German car dealer who was buying what he thought was a marvellous bargain from a website in Germany, which turned out to be run by a Belgian company. He was presented the terms and conditions. He clicked to say, yes, I agree these terms and conditions, and of course didn't read any of them. And one of the terms and conditions was the fact that this is a Belgian company, and so any dispute was going to take place in the Belgian courts. When the Belgian company pulled out of the deal, he sued them, and the issue was, well, is he bound by the fact that these terms and conditions required the dispute to be heard in the Belgian court? And the Court of Justice had no hesitation in saying, of course he's bound. He had the opportunity. Nobody's saying that it was illegible or it was in any way misleading. It just was he chose not to read it, but he signed to say he had read it. So, case closed. Once you've been given the opportunity, as long as you can show the opportunity there, that's enough.
Are there any nuances of the law that present any opportunity to challenge what constitutes sufficient opportunity to read it?
Well, clearly, if you flash it up on screen and take it away again, so that you'd have to be Superman to have an instant photographic record. That's not going to be sufficient. But if it's there and the consumer chooses how long they spend looking at it, and they go, yeah, fine, just get me the signature.
Yeah.
That's not your fault.
Yeah.
You've got to make sure that an ordinary human being could have read the terms and conditions if they had wanted to do so. And that might be, in some case, of somebody who's familiar with these kinds of contracts. It might be a couple of minutes, scan through and look at the important terms, or it might be for somebody doing their first ever credit agreement, 5, 10 or even 15 minutes to try to make sense of exactly what the agreement is covering. But it's got to be the customer's choice, not the lender, putting them in a position where they don't have time to do the job. If they choose not to do the job, that's the customer's fault.
Yeah.
Well, sometimes we find with the lenders with whom we work, the compliance department or the lender will ask us to mandate a minimum amount of time on particular sections if they and also a minimum amount of interaction that we can then record. So a kind of rough rule of thumb is the greater the level of risk of a particular term or particular part of the contractual process, the more the lender wants us to enforce interaction and create evidence and to be able to record and replay that evidence. So we can dial up or dial down the evidence dependent upon what the lender and ultimately driven by what the regulator thinks is appropriate.
Yes. That's certainly an important point where you're dealing with non-standardized transactions. So if you're looking at a fairly simple use case where you're buying a car or you're buying an expensive piece of hi-fi, and the terms and conditions are going to be rolled out across millions of transactions, the lender's lawyers, the retailer's lawyers will have agreed that everything in there is suitable for a consumer transaction, then there is no need to highlight or spend time or demonstrate that time was spent on any particular term. If you're doing this in the situation of a more customised or a more unusual transaction, so there might well be terms in there that even I would look at and go, hang on, does it really say that? Then you need to show that time has been spent looking at that unusual provision, because there's a ground for challenge just on the basis that it's an unreasonable provision.
Sure.
But for most of the transactions in the financial services world, they will be very standard terms, and there's no need to highlight particular aspects.
And what would your view be on the difference of approach, where oftentimes we see traditional systems producing quite limited information about the nature of customer interactions, sometimes just textual, versus a kind of visual log of what the customer actually did going through the process?
Well, the more information, the better. If there's a textual log, you will be able to demonstrate that certain shifts in what was being displayed on the computer screen took place. You can't necessarily show that the consumer was even present when that took place.
Yeah.
Somebody started a process running on their machine and then stepped aside to finish their cup of tea or look out the window because Superman went past. Now that we've got Superman in the discussion.
Yeah. We're going for a third reference. Superman later on.
It's going to be up to the challenger to say, well, because of this text representation of what took place, there are gaps here that I'm not comfortable with, or in which I can say something else happened. But if you've got a visual log of the whole thing, they're going to have to claim that there's been some very whizzy Photoshop editing process taken place, such that whatever they say happened or didn't happen was there in the original record and has now been taken out. And of course, evidentially, that's going to be extremely difficult. Forensics, looking at any kind of electronic record these days, are a fantastically powerful way of finding out every time a single bit's been changed. So the scope for winning on that challenge, you can never stop people bringing challenges.
Sure.
People will bring challenges when they haven't got a snowflake's chance in hell of succeeding. You won't stop people bringing challenges, but you will make it much harder for them to succeed.
Okay, so the message is visual, less risk, textual, slightly more risk, but overall. Okay, understood.
What is the kind of climate like for enforceability claims against credit agreements? Because a few years ago, there were companies around like Credit Card Killer that were capitalising, I think it would have been 2008-9, maybe a bit later than that, in the kind of 2 years immediately after the financial crisis. There seemed to be a proliferation of them, and they were subject to panorama investigations, etc. And since PPI took over and dominated for the following decade, you don't tend to read as much about them, but what can you tell us about activity amongst those sorts of claims firms looking for opportunities with credit agreements, particularly that are, let's say, non-PPI, where they're looking for loopholes in, for example, what the customer did at the time?
Well, I'm not sure that's totally our field. So that's a difficult one for me to answer. I can answer really just anecdotally.
Yeah.
I think that coincidentally, my father-in-law works for Citizens Advice.
Oh, okay.
And
good source of information.
Well, this is okay. Bear in mind, this is anecdotal. They see an increased number of people coming in talking about bad debt and having debt issues. And increasingly, Citizens Advice have been helping those folks understand the ways in which they can get out of agreements. Now, when you have an organisation like Citizens Advice, who previously helped with PPI, turning their focus, such a legitimate organisation, turning their focus to kind of credit agreements in the round, it's got to make you think.
Yeah.
The extent to which claims companies are likely to then focus on credit agreements or motor finance in the round, I would say at the moment it's conjecture. But as per your introduction, they're going to have to be doing something. So ask us that question in a year's time, and maybe we'll have a more concrete answer for you.
Yeah, I agree. At the moment, they're still doing PPI. I haven't seen particular challenges coming on this kind of agreement yet, but the PPI gravy train is coming to an end.
Yeah, so definitely, and they'll need a new ambulance to chase once that ends. Sorry, continue.
Yeah, so I think the penultimate point is really about evidential ease of use. And this is an interesting one. I again think of the chap that I saw from the High Street Bank. You can have, oftentimes we see, particularly when we're replacing own-built systems by clients, their systems produce quite a lot of evidence, but it's quite obtuse and it's quite IT-centric. So you have lots of different database notations in different places, sometimes in different formats, some with third parties, some internal, some digitally signed, some not. The greater extent to which your evidence requires IT, particularly, to go and find, retrieve, and possibly, God help you, explain to a customer or even a regulator or a judge, the more difficult it is for you.
I can jump in here with lots of examples of cases. The very first big case I was involved in back in the late 1990s was a dispute between two huge companies, and we spent an awful lot of time and money getting to the answer of who is right and who is wrong. But then we had to come on to the question of, okay, how much does the party who was wrong have to pay? Obviously, the subsequent question. And the evidence just proved to be too difficult to gather. This is back in the mid-1990s, so there was a question of restoring backup tapes from mainframe computer systems that had been archived a few years earlier. There were records held on paper and records held in email and records held on floppy disks, which of course had gone missing, or some of them had, so you had partial records, so you could see that there should be the information, but you couldn't find what the information would have been. And the party settled. They just gave up trying to get. It was too difficult. It was. I probably spent over a year on that, and I talked to a lot of IT people.
Yeah. Lovely people, one and all, but generally don't get the idea of trying to look backwards in time and unravel things that they've moved on from. Why do you want to look at those backup tapes? We've got this brilliant new system now. Well, yes, but the new system doesn't tell me what happened 5 years ago.
Right.
It happened with American Express. I know this is a piece of US case law, but the implications of it are interesting for the UK. So I think it was 2003, American Express versus a guy called V. Vinny, who went bust, and he owed American Express something like $30,000, and he was taken to court. V. Vinny won, not because he didn't sign an agreement, but because the evidence that American Express's IT had produced was so complex, difficult to find and explain, that they lost the case. And what they had inadvertently done, American Express, was made themselves beholden to their IT's oratory ability in a court of law for the enforcement of billions of dollars worth of credit agreements. You think anyone on this call who's produced an own build system, either in full or in part, Is that your situation? The people on whom who will use the evidence, administrators, lawyers, the people on whom the evidence is used, customers, regulators, judges, these may not be technical people.
Yeah.
So unless your evidence is easy to find and super compelling, you may have an issue downstream.
It's true. So yeah, this is the point about evidential ease of use, I think, brings us on to which could be very important, I think. There's a kind of supplementary question I had on this where lenders kind of need access and use the original credit agreement, such as when they're subject to a regulatory audit or request, or an internal audit, perhaps a securitisation event. We've got elements that come through this year, such as the pre-action protocol for debt claims, which requires that as well. So perhaps you could talk us through what automation enables in those kind of circumstances when there's a call upon to extract that quite important, completely critical information.
Absolutely. The whole point is having an automated process. You will be capturing all of the information, what the agreement was, what the customer saw, what the customer did, and who the customer was, in a single place, so that when the challenge comes, or just a routine, as you say, audit by a regulator, you can press a button and go to a single source and have all of the information that you need in a form where you can demonstrate that it hasn't been changed or interfered with in any way since it was first compiled. And the best physical systems in the world generally don't result in that kind of single source information that the regulator is looking for.
Yeah.
So that brings us rather neatly onto the kind of last criterion for best practice, which is rather wordly called evidential propriety or appropriateness, completeness and integrity. So to Lorna's point, it's a great point. You can have the best evidence in the world, but unless your evidence is complete, think of it like a chain. Unless you have all of the links in the evidential chain, and unless you can prove that those links are linked, i.e. you can prove they were all derivative uniquely of the same transaction, and unless you can prove that none of that evidence has changed, or even could have changed by accident or design, you are to some extent on the back foot. And so if you accept those as principles, I must have all of the evidence. The evidence must be, it must have integrity, and it must be the appropriate evidence. Then the question is, how does one go about doing that? From our perspective, not wishing to get particularly technical about this, there's only one real methodology. Assuming that we have all of the evidence that we need, including identity, anti-impersonation, the contract, what the customer did in the contract, whether it be a visual or a written log, possibly even things like affordability checks. Really, anything which is material to the enforceability. That's what I mean by completeness and propriety. To prove that all of that information or that evidential data is derivative uniquely of the same process, and also to prove that none of that data could have changed, two things which seem like no-brainers, really you have to have a single package of data, and that single package has to be rendered tamper-evident by some mechanism. Now, typically the mechanism that in Europe we've used, or globally we've used to date, is PKI, the use of digital signature. But also it could be achieved theoretically by use of blockchain. So those are some, philosophically, at a high level, some of the criterion for best practice, although maybe not strictly legally necessary, are more of a common sense approach. Lorna, I don't know if you have any comment around that?
No, indeed. Courts have always had to tackle situations where they didn't have all the information that they ideally would have liked to have had, and have had to come to a conclusion based on what they could access. The question for the audience and for the consumer, indeed, is what outcome is that going to be? Is it going to be a gap in the evidence that leads the adjudicator to say, well, I'm not actually convinced it was this person who signed? or I'm not convinced that you did show them the prior information that the regulations require you to do, so I'm not going to enforce this contract. So you can take a gamble, essentially, on having disparate sources of information and being able to reassemble those when a challenge arises and hope that the right pieces come into place. But if you can have all of the information in a guaranteed form, such that whatever the challenge is and whenever it comes up, then you will be able to point to all of the relevant information, that's clearly a safer place to be.
I think that this also touches a point that you made at the beginning of this section, Marcel, which was around really almost logistical convenience in the organisation.
Yeah.
So again, we see situations where if there are lots of distributed bits of data, forget the legal issues or the compliance issues, just logistically that becomes a problem. You know, if a bank is doing millions and millions of agreements, and each agreement is split into lots of different bits in different places, just keeping track is difficult, let alone finding all of that evidence and presenting it. But also moving the evidence around the enterprise could be difficult. As you say, how do you optimize the value of a $1 billion securitization event if the underlying assets are so difficult to track and impossible to prove? So just practically, there's an advantage to this kind of approach that we see on the screen now, where we have single package, all of the evidence in the package, everything rendered tamper evident. It means a couple of things. Firstly, that the enterprise shouldn't have to have a kind of proprietary storage mechanism to store all this stuff where they can prove nothing has changed. The package itself should do that. Secondly, if an organisation wants to move the package around, they should be able to do that. Especially if it's a non-proprietary package. In the event of M&A or securitization or just replatforming, organisations may want to do that.
Yeah, so I was going to ask about that. So when lenders are migrating onto platforms, this becomes even more important.
Absolutely.
There's fewer disparate bits of information, and the way in which they're stored makes that an even greater challenge, I would imagine.
Absolutely. And also, one really wants to avoid any forward dependency on any third party who's helped to create this package. The lender should 100% own the package, regardless of any relationships they have with third parties.
Yeah.
This is the big problem that is going to emerge in the next 10, 20 years as so much more of everyday life has become normally electronic in form, is we're just not paying enough attention to archiving. The time was when you signed an agreement and you stuck it in a bottom drawer somewhere and subject to fire or a very bored burglar, it would still be there in exactly that form when you came back. But the programming language I started off on was Fortran 77, which from its name you can tell started in 1977. And it's quite nice that actually it's become highly desirable again, because there are some very important documents that were written in that language that no modern programmer can access them anymore. And the same is applicable to, I worked in WordPerfect for my first year as a practicing lawyer. Where's WordPerfect now? If you've got documents that are stored in those formats, they're not accessible anymore. So this question of migration and changing formats is going to become more and more important, and something that lenders will need to pay much more attention to.
Yeah, according to Forrest, that's an interesting point. According to Forrest, the sort of least risky, most likely to be pervasive format for the storage of contractual data is PDF.
Yes.
You could argue that's
had longevity.
Yeah.
Okay, so I think we're going to come on to a question now, unless there was any final points on evidential propriety. Question, tell me, when you undertake an implementation, are you typically replacing paper, or do you replace an incumbent e-signature solution?
Well, the answer to that question has changed over the years. So 5 or 6 years ago, when we really came to market, it was usually greenfield, so we were replacing physical processes. Today, I think probably maybe 70, Ali might correct me if I'm wrong, 70-80% of our implementations are actually replacing either own-built systems, often by lenders, or more often traditional electronic signature services, which have been augmented by the lender with things like ID checks and various other things. A kind of we call them Frankenstein solutions.
Bolted on.
That's a bit. That's a bit negative. Well, we would do. But
sometimes lenders are negative about their own legacy systems. So
I couldn't possibly say.
Okay, so one point that we mentioned only briefly, probably at the start, is open banking and PSD2. So I think automation obviously is highly relevant and present in that context as well. Perhaps you can tell us about that, where it kind of fits in.
Yeah, well, I mean, PSD2 is just going to create much more competition, really, for traditional lenders. You may start to get a dichotomy within the marketplace of manufacturers, people who manufacture and run the product, and then on the other side, people who really own the customer experience. When you start to get folks like retailers coming in on the action, retailers who have traditionally been extremely good in creating really compelling customer experiences, the bar is going to go up. And so, if lenders intend to keep in control of the customer experience and keep the customer close to them, the bar in terms of creating a fantastic user experience for onboarding is going to get higher. So I think a lot of our lenders recognise that.
Okay, another question that's come in as we're talking about kind of directives. This is a piece of major new legislation coming in next year. So how specifically do you think the requirements of the forthcoming GDPR regulation will affect what you have discussed today? Quite a big question, really.
Yeah, I was thinking we could do a whole nother
that's a webinar
on GDPR.
After it comes in.
In terms of the customer experience, not a lot. I mean, there will be additional requirement. I mean, Lorna probably pitch in on this, but there will be additional requirement to in our case, visually record the fact that the customer has accepted the way in which the lender may want to use the data. And that's going to be important. But a lot of the rest of GDPR will really be under the hood in terms of how both the lender and the lender's third-party suppliers treat that data, secure that data, store, manage that data, and ultimately delete that data.
Yeah.
Yeah, I would say, because what we've been talking about is the contract formation process, GDPR isn't going to have that much impact at all. But what it does do is make it incumbent on lenders not to have this kind of data being exploited for purposes which are not related to this transaction, for instance, or not in an identifiable form, and certainly not stored for any longer than is necessary for the purpose of the transaction. So the deletion point that Abe made is the key one that the GDPR will bring people's minds to, which they might not have had before. But as to the onboarding process itself, not that much impact.
But actually, with deletion, regarding deletion, that is an interesting point that just occurred to me. Again, if you have lots of different third parties holding your data, maybe a bureau holding some identity data, somebody else holding some AML data, it does make it increasingly difficult over time to ensure that you have control and also that you've deleted all of that sensitive customer information at the appropriate point.
Okay.
So I mean hence Frankenstein solutions or multi-component solutions can present more risk.
Yeah. Okay. I think we've got time for just one more. What responsibility or facilities do e-sign platforms have to ensure that contracts can change ownership, e.g. for assignment, purchase, receivables or block discounting arrangements?
Yeah, so I mean, I think any good e-sign system, if we're just talking about e-sign vendors, should accommodate change of ownership. I think the bigger challenge is what's the way in which you accommodate change of ownership. So philosophically, there are two things that we try to do to assist our clients in that. Firstly, as we've mentioned, create a single package of data which has its own inherent integrity and security, and which is comprehensive and where there's no forward dependency. So the lender can move that data around, that package around easily and however they like. And the second is if we're vaulting the data, if we're vaulting those packages, which sometimes we do, sometimes we don't, is to, rather than move the packages around, change the access privileges to the packages. So if you've got a vault of a couple of million credit agreements, rather than shift those credit agreements to the new owner, you just change the access privilege to the new owner, and and you can keep a record of that, of course, and that can sometimes be logistically a lot easier. Or you can do both, belt and braces.
Okay, great. I think that's perfect time to end there. I think we've got about 20 seconds left. Any more questions? We can put those to Lorna, to Abe, to come back to you separately. But thank you all for joining us, and thanks very much to Abe and to Lorna for hosting.
Thank you.
Thank you.
Thank you.